Welcome back to the Small Business Mindset. This episode is part 2 of a 2-part series, and I want to talk about financial analysis for investment properties. Now, you might be someone that has no desire whatsoever to own an investment property, but for many of my clients, the question I get asked is that as I grow my wealth and grow my finances throughout my life, what are different ways that I can do that? And one great way is to consider investing in property that is income producing. So in part 1 of this 2-part series, we talked a little bit about net operating income and what that means when evaluating an investment property, and then cap rates and what that looks like and what that means. And then yield, when you're looking for financing to purchase a property, how does that compare with those other elements to make sure you're making a good decision? So in part 2, I want to take a little bit deeper dive and look at some of the other elements of investment properties. So for those of you, I'm not going to complicate things because I know I like to work things pretty simply and understand just a lot of those basic elements that go into owning and purchasing and even selling an investment property and what that means to you. Because the name of the game is to be able to buy something that makes you an income, increases in value, and then at some point in time when you're ready to sell it, you sell it for a profit. So that's the trifecta. I'm going to make this pretty simple, and I don't want to get into a lot of complicated analytics and financial problems because I want you to be able to have the skill set that you can assess from a very simple mindset a lot of the elements to make a good financial decision and understand those things. So I'm not going to go into bank finance. We covered that in a previous episode. And I'm not going to go into some of those finite details and those analytics. I'm going to keep a little bit more of a 30,000 foot view, just so you know and understand what you're looking for when evaluating this type of asset. So one of the elements that we're going to talk about is your rent roll. And so, for example, on the last episode on part 1, I used the example of an office building that had 4 tenants. And I made the assumption that all 4 of those tenants paid exactly the same because maybe their office spaces were exactly the same size and their rent structure was exactly the same. And in that scenario, each of those 4 tenants paid $1,000 a month. So if you are listening to me only on wherever you get your podcasts, I'm also recording this on a video. So if you want to jump on my YouTube page and take a look at this and see some of the visuals that I'm writing down, feel free to do that, or feel free to listen once and then go back and take a peek. So 4 tenants, $1,000 each per month, $1,000 per month. And in my last episode, I talked about, okay, how do we get that net operating income? So $1,000 a month times 4. So total is $4,000 a month. Total per month, $4,000. Times it by 12, times 12 months in a year, $48,000 per year. Now that's our net income because we haven't taken out any of the expenses. And those are some of the things I'm going to dial into on this episode. So part of the expenses, and first you might ask, how do I get those expenses? Well, you can arrive at them in a variety of ways. If you know the property owner, or if the property is a listed property, meaning it's being marketed for sale by a licensed real estate agent, that person will most likely have this information that they can share with you. They might require you to sign something as a confidentiality statement, so you keep that information private and they want to make sure you don't share it with people. That's perfectly fine to sign because as you're evaluating properties, you do want to have access to this information. So some of these expenses might include or do include property taxes, property insurance. They might include some maintenance that has happened with the property. And when you look at expenses, you don't just want to look at a snapshot of the last year. We'll go back a few years and see if those things have increased or decreased. For the most part, property taxes should stay fairly consistent with some small bumps year to year, unless it's a brand new property, meaning it just came on the tax rolls and the county that you live within hasn't yet really evaluated the value of that property yet, so you might see some spikes. But for this example, I'm going to assume that this property's been around for a while and really no major things have happened. It's a pretty stable property. So you might see year to year some slight increases. Same with their insurance load. So it's typically year to year as you get property insurance, whether you get it for your home or your car or whatever, those premiums tend to tick up a little bit too. So you should see that gradual increase over time. Maintenance also might be something that hopefully is pretty stable, but you want to understand exactly what those maintenance costs are. It might mean that the owner had to put a new roof on the building or make a major repair. You want to make sure those are documented, because if it's something out of the ordinary, let's see, average expenses for a building like this typically run $4,000 a year. And then 1 year, 2 years ago, they jumped to $20,000. What's the rationale for that jump? Is that a normal occurrence or is that a one-time occurrence? And what's to be expected? So on the expenses, sometimes people also, or owners, will create a management fee in there. They might add some bookkeeping fees or legal fees or postage fees. There's all kinds of things that they can include from a tax deduction standpoint if you own a property on that list of expenses. And that ultimately will create that net operating income from your gross. So let's say for this property, we're going to keep it pretty simple. Let's say you got some property taxes, and I think I used an example last time, but we're gonna just use some rough numbers. So your property taxes are $4,000 a year, and I think my marker's giving out. Let's say your insurance on the building is $2,000 a year, and let's say you have maintenance costs of $2,000 a year. We're just going to use some simple math. So about $8,000 in expenses. We're going to deduct this, so your net operating income is $40,000. Now, here's where you can get a little savvier as a property investor. What I want to know is a couple things. I want to know, okay, so those 4 tenants are paying $1,000 a month. Could they pay more? Is that the market average? Is that what the expectation is for the space that they're renting? Here's how you find that out. Connect with a local licensed real estate agent that knows the market in this way. If you're buying a commercial property, make sure you connect with a commercial real estate agent. They are different than residential. If you're working with a residential property, and residential properties, if they're multi-tenant, would mean a 4-plex, so 4-tenant, residential unit or less. So single family, duplex, triplex, up to 4-plex. Anything higher than that is actually considered commercial. So you think about a 20-unit apartment complex, that would actually be considered a commercial property. But the name of the game here is to connect somebody that knows the local market, that knows the trends, knows the costs, knows the value, and can give you some really solid data to make a good decision. And that's somebody you definitely want to have on your team as you're evaluating investment properties. Okay, so here, maybe if you did some research and you realize that, similar types of properties, and that's where you have to get a little bit into the weeds. What's truly a similar property? Similar location, similar finish level, similar amenities. What are they paying per month? Well, maybe during your market research, you found out, you could actually command a little higher rent. Maybe they should be paying $1,100 a month instead of $1,000 a month. Well, let's do some math here really quick. What if they paid $1,100 a month? Each tenant did. That's an extra $100 a month per tenant, an extra $400 a month for total. So 400, we're going to add 400 a month times 12. And so if we think about that, an extra $4,800 per year. Now you might say, okay, well, that's nice, but that, that covers your entire tax payment. You plug that back into your bottom line. If you can just increase that rent by $100 a month, this is just an example, you plug that back into your bottom line, now you're making $44,800 net after your expenses. Because your expenses, might not change a lot. But here's an opportunity when you're evaluating properties to say, if I buy it, and I buy it at the current, the current rate, whatever the price is, we're not talking about price right now, is there an opportunity for me to have a higher income? Maybe. There very might well be, and understanding market knowledge to get you there. In addition, other things that just from understanding the market and being able to raise rent to be in line with the market, there might be some other added amenities that you could offer to your tenants to increase their rent. Things like improvements. Does the space need a fresh coat of paint? Do they need some upgraded technology or upgraded LED lighting? Maybe a fresh, flooring or carpet needs to be upgraded before a new tenant can move in. If you have a solid tenant mix, meaning your tenants have been there for a long time, they pay on time, that's really a good place to be in. But how could you improve upon it? Could you extend their lease and say, hey, listen, if you sign a new lease and you extend it out for another few years, and I throw in a fresh, paint job and maybe some new carpet, could I ask you for some increased rent, even more than $100 a month? Now, what you do have to do is understand what is your expense as a landlord to repaint or recarpet or to add those improvements into the space. So if you can get an extra $4,800 a year, is it worth it to you? And this is where you do your simple math. How much would you have to spend to get it to that? Or if you spend that, could you charge more? So it's just toggling the numbers a little bit to understand, okay, how much do I need to put in, investing up on the front end to get the return on the back end, and getting creative with that. One other thing I've seen landlords do in the last few years is adding those extra services like Wi-Fi. So most businesses need internet access to function, whether you're a residential property or a commercial property. That's almost the norm. In a lot of ways, it's considered a utility. But what hasn't been decided is all the time is who pays for it. Within some leases, the tenant pays for it, and they pay for it directly out of their pocket, and it's handled. In some cases, the landlord pays for it. So here's a creative way to think about Wi-Fi, which is one utility. It might mean that you get a hold of your local internet company and say, hey, listen, I own a multi-tenant building. And in this case, it's a four-tenant office building, and all of them need internet access. What kind of package could I negotiate with you to give internet to my tenants? And they say, oh, well, if you're getting 4 units, then we'll give you a deal. We'll charge you $100 a month for those 4. So let's add another $100 a month for that Wi-Fi. $100 a month for Wi-Fi, or $25 a tenant. But instead of charging them just $25, charge them $50. Because maybe that $50, and I'm using some assumptions here, maybe that $50 a month is way cheaper than what they could go get it on their own. Maybe if they got it on their own, it's $60 or $75 a month. But you figure out what the threshold is. Is it a deal to your tenants for you to offer the service? And then can you charge a little bit of a premium, but keep it below what they do themselves, for you to have that contract? So these are just some easy tips and tricks to figure out how do you pad the income side to create more money on your bottom line while trying to keep your expenses as low as possible. Some other things I also encourage, and I mentioned property taxes and insurance. Insurance is something you should be shopping, meaning you should be going out with your insurance agent and looking for different policies every single year. I love to use insurance carriers that offer multiple lines. I just don't want to go with one line because they're a broker, because they can go out there and say, hey, listen, here's the property I'm trying to insure. Give me your best deals. And do that every year, because sometimes things change, or sometimes your circumstances change. You add a building, you add a car, you bundle things a different way, and circumstances change enough that if there's a savings to be had, you want to know about it. You don't just want to assume that your insurance agent is going to do it for you automatically, and never assume that your insurance agent is ever going to just automatically give you a discount without you asking. So that's another area year to year that you can reprice your policies and make sure you're getting the best deal possible, because there could be some savings in there. It also might be worth considering within your insurance deductible, what that looks like. Just making some simple changes and understanding, okay, how much of a deductible can I handle? So if, the roof does need to be replaced, or there's damage to the building, do I need to keep it at $1,000 a month? Could I go up to $2,000 or even $5,000 a month? Do I have enough cash reserves from the income I have to accommodate that if it makes sense? Sometimes making adjustments like that will allow your premium to be deducted, so therefore your income is higher. So you have to consider your risk factors. Are you in a position where you think you're going to have to file a claim this year? What are the weather patterns? What's happening in your neighborhood or in the area that you're in that could result in a claim? And so these are all great questions to sit down with your insurance professional and have those conversations. So last thing I want to talk about as we're kind of doing just an overriding look and a blush at investment properties is your exit strategy. Now, sometimes you might do the math and you think, you know what, that is a good solid property. It's well maintained. It performs from an income standpoint. Maybe it doesn't blow it out of the water, but it's a good solid property. Every year, maybe I can ask for a little more increase from my tenants to continue to combat inflation, because your expenses will go up. I guarantee you, especially property taxes and insurance. You want to make sure the rents and the net income coincide a little bit, so you're continuing to make a good income off the property. Now notice I didn't say the exact same amount every year, but you do want to level up a little bit so that way you're not falling behind. But more importantly, every time I meet with a client and I ask them from day one, what's your exit strategy? And sometimes they look at me like, whoa, wait a minute, I'm just getting into the property. Well, here's something to ask yourself. How long are you going to own the property? Is this something you want to park some money and maybe, get it on an even keel, get it performing, and then sell it for a profit right away? In this economy, that's probably not the best choice. In fact, what I'm advising a lot of my clients to do is buy it and hold it. Hold it for 5 years. I think, within the next few years, we're going to start to see interest rates stabilize a little bit more. And that's a great time to kind of take a deep dive into the analytics of your investment property and stabilize things. Other people might say, I have no desire to get rid of this for another, 20 years. That's great. Hopefully over time, you will continue to maintain the property, keep it leased up, keep it functioning and thriving. And then years from now, you'll sell it for a profit. That's the name of the game here, and really trying to get ahead and build wealth through real estate. So I hope I've given you a few tips to start taking a look into getting into investment real estate.